Welcome back. Today we're diving into Lesson 18, Non-Current Liabilities. Understanding long-term liabilities is about more than just numbers. It's how we measure a company's long-term survival, or solvency. Hello everyone, Matt here. We've already covered current liabilities. Now we're looking at the obligations due more than 1 year from today. By the end of this lesson, you'll know exactly what these represent on the balance sheet and how they impact a company's ability to cover its debts. Non-current liabilities, often called long-term liabilities, are obligations a company must pay in more than 1 year. On the balance sheet, you'll always find them listed directly beneath current liabilities. These liabilities are the core of solvency analysis. It answers the fundamental question: does the company have enough assets and consistent cash flow to cover its debts over the long haul? If a company can't meet these, its long-term future is at risk. The most common long-term liability is long-term debt. This includes the non-current portions of term loans, corporate bonds, and notes payable money borrowed to fuel growth or operations. But it's not just bank debt. We also see non-current lease liabilities, pension obligations for employees, and long-term provisions like funds set aside for legal settlements or environmental remediation. Often you'll see a line called Other Long-Term Liabilities. This is a catch-all category for smaller obligations that don't quite warrant their own separate line item on the statement. When we add current and non-current liabilities together, we get total liabilities. These represent all claims on the company's assets belonging to non-owners, essentially, everyone the company owes. To recap, long-term liabilities are due after 1 year. They are critical for solvency analysis, and they encompass everything from bonds to pension obligations. In our next lesson, we'll cross the final line of the balance sheet to look at the claims belonging to the company's shareholders. See you then.